Hi everyone, welcome to this live event. Here we are again for our weekly review. Let me start by sharing the macroeconomic calendar with you guys and check what we have in there for these days. I was thinking just before starting this coverage and even for watching the calendar that we are going to have a quite interesting month because there are many events that are of high risk, starting with the ECB on Thursday, payrolls on Friday. Then we have the Fed meeting on June 15, Bank of Japan meeting on June 16, and the Brexit referendum in the UK by June 23, Spaniard elections, OPEC meeting. This is going to be a really, really busy month, particularly because, except the ECB, we're expecting some action from most central banks, right? We're expecting the Fed to move rates or at least open door for a hike in July. We're expecting the Bank of Japan to add some stimulus, or I don't know, maybe finally delay the sales tax. There's a lot of things that may go on this month, so I really hope it's going to be a quite interesting one to trade. Although keep in mind that we are entering summer in the north hemisphere of the world, which means by the end of June and maybe after the Brexit referendum by the end of June, market will probably get into a boring range that will last July and August, right? And we are not expecting much definitions there if we don't get before. So hopefully the central banks and all this activity I was talking about will give us some clues for what to do in the North Hemisphere summer. Anyway, and talking about the fundamental and macroeconomic calendar, we have some action today. I do expect the personal consumption expenditure, personal income, personal spending data from the US shed some light over the US future and inflation and consumption, which is the only leg the Fed decisions are resting these days. Employment has long ago become a non-issue for the central bank. So keep an eye on those and see if consumption is actually growing, because growing consumption will mean the Fed is a step closer to rise rates, and therefore the greenback could accelerate its advance despite this modest decline we have seen at the beginning of the week. Canada will release its GDP. I'm sorry. All my family has the flu, and I'm not exempt of some cold these days. Anyway, I would say in Canada will release its first quarter GDP readings, expected pretty strong analyzed quarterly reading, right? 2.9 against previous 0.0. I believe that expectations may be a bit too high. The deception of this could put the CAD under pressure today, even despite oil prices remain strong. As I mentioned a couple of weeks ago, I do believe that the correlation between oil and Canadian dollar is easing. It's not lost, but just easing. And maybe today the market will focus most in that than in oil prices. Anyway, on Wednesday, I do believe that we will have even more active day because the UK will resume releasing data after a long time. But before that, we have the market and the official Chinese manufacturing and non-manufacturing PMIs. Chinese economy has been for the most contracting. We have some positive readings starting last month, but still we are mostly below the 50 level, right? Which indicates the economy is contracting, not expanding, and therefore, of course, I was trying to say that the Chinese economy contracting has been the main reason why during the first quarter of this year, and we have so much worries about the economic slowdown affecting all major economies, right? So a positive reading in the year will probably spook farther away the ghosts from economic slowdown, and maybe even also help the greenback to advance, despite we're talking about Chinese data. Alongside with the PMIs from China. We have Australian GDP figures altogether, and the Aussie is the one who will probably react the most to these figures. Give me a second, please. Sorry, guys, Anyway, I was saying the Australian dollar is so always usually the most affected by Chinese data. So if it comes alongside with GDP figures, it will probably make a bit of noise in the Aussie dollar pair, right? I was not watching, but we are expecting a tepid growth in a quarterly basis, but below previous year one on a year-to-year comparison. Uh, could be in line with market current negative sentiment towards CLC, particularly if the figures are more tepid than expected, and therefore send the currency towards fresh multi-month lows, right? Anyway, as I was saying, the UK will resume bullish in data, right? We have some housing favors and the manufacturing PMI, which will also be released for all Europe and the US. So I guess we are going to see some activity until the release of US market PMI in the US. It's Wednesday, right? And on Thursday we have the ECB, right? So that will probably mean that the market will enter after the release of the report. This report, sorry, the market will probably enter in a consolidative stage, right? With mayors remaining within limited range bound, sorry, ahead of the ECB release. Okay, and I was trying to get out Okay, I guess I'm back. I lost connection. Sorry for that, guys. Internet is pretty messy today in here. I'm sharing my screen again. Okay, thank you. Sorry for the interruption. Connection is sucks. Sorry, I was saying that this Friday, okay, we will start the day with the services sector PMIs in all Europe, but of course, the main attention will be the US Nonfarm Payroll report. The headline it's barely expect to have grow 1,000 new jobs, really nothing relevant. Unemployment rate is expected to tick lower, 4.9, which will be quite interesting. But overall, I do believe that the market attention will remain in earnings, wage, and salaries because that's what's driving the market lately, right? Higher wages are more consumption. More consumption means more inflation. More inflation means the ECB can raise rates, right? In the meantime, if wages are low, the Fed won't be though that happy to raise rates. So that's the key in employment reports, the earnings. Okay. Let me take you. Sun is coming out. Let me share my charts with you. Okay, here we are. Uh, Let me start with Euro with this daily chart. I have been following this daily ascendant trend line coming from November low, which stands at 1090 for today, 1080, right? And we had an approach to that trend line, which is also around the 200 simple moving average in the daily chart. And we are currently seeing the pair bouncing from the level. I do believe that it's more due to some profit taking. Remember, today is the last day of the month, and it's quite common to see big firms booking profits from their monthly movements. And if you take a look, the euro has been pretty much falling ever since the month started. So it won't be a shock to see the greenback easing today, particularly on profit taking. In the short term, if we hold above this 1160 region, we have scope today to test 112, particularly if upcoming year's data is weak, right? And above this level, I could see the pair extending up to 1240, 50, but not much more, to be honest. I do expect some selling interest came in if a pair moves beyond 12 and add to the short positions because for the last 2 weeks, all of the main market mover has been expectations of a Fed rate hike next June, right? Anyway, those are the levels to watch for today. 1120 is the immediate support, followed by that 1090. Seems hard the pair can break below this region today, but if it does, then 1050 seems the next probable target for today. I don't see it. Of course, if we lost that level during the upcoming days, the 110 figure will be the next one. I don't expect the pair to test this level 110 or even break below it before Friday. I don't know, unless we have a strong surprise from Draghi, which none of us is expecting on Thursday. I could expect the pair to be between 110, 112 this upcoming 2 days. And then with payrolls, we may or may not break one of the extremes, particularly if we are close to them, and that surprises, right? I don't know, double wages, job creations above 200, that can push the pair below 110 if we are holding nearby or below or around 111 ahead of the release. But anyway, 110 seems a nice floor for this upcoming days, okay? Of course, if we close the week below the trend line, below 111, there are chances that the greenback will resume its advance next week. Okay, here we are with the pound. Trading has been quite choppy lately in here after we reach or approach to that early May high around 47.70. In fact, right? We've been as high as 47.39 last week, and today we have a spike closer to it, 47.24. Yes, 27, sorry. So overall, the pair is it's lacking definitions, but what I can make out of these charts is that buying interest is in growing, its persistence, and despite the pair can go higher, depths are seen as buying opportunities. So we have all of this recovery and a retracement resulted in a retest of the highs. Of course, we are posting lower highs, right? But overall, I still believe that there's room towards the upside because dips below 46, at least for the past 4 or 5 trading days, have been quickly reverted and fueled a recovery up above that level. But there are no clear definitions, no clear trend marks, and at this point, since we will need to beat that 47.70 to confirm a bullish continuation, a steeper bullish continuation uh, mm, for the upcoming sessions. At this point, 46.30, we have an immediate resistance around these previous highs, 46.60 region, right? And above that level, I would expect the pair to go back to 47, 47.20. Seems that we are not heading too much higher today. Uh, that's the most I'm expecting for it. And as I said, below 46 spikes, that dips below 46, uh, I'm still seeing a strong buying interest surge in there. So honestly, I won't be a happy buyer unless the pair falls below 45.60. That will put some additional pressure over the pound and probably favor a decline towards 44.60, 44.80 region, but that's the most I can see right now. Anyway, not clear trend, but buying the dips and selling on spikes in the really short term, um, unless we break above 47, the upside seems to be the name of the game, which not pretty comfortable, right? The dollar Japanese yen broke higher at the beginning of the week, right, on Monday, when we have the UK close and the US close. Pretty surprising. Mostly, this movement has been attributed, sorry, to Friday's comment from Jeanette Chalene, which speaking at the Harvard University about herself and not about economic policy, got asked about a rate hike, and she repeated that she says a rate hike appropriate in the coming months should the data back the hike. She actually did not said anything new, right? Nothing that we didn't already know. But the fact is that the news fueled the greenback, particularly against the yen. There are a couple of things I'm making about this. The first one is that despite the latest recovery, we have not yet erased the reaction to the late April Bank of Japan meeting, right? When the pair plummeted because the bank decided to leave its economic policy on hold. That's the first thing we can make out of this. The other thing that we can make out of this is that the Bank of Japan was worried when the price was approaching to the 105 level, right? Sort of a line, non-spoken line in the sand, okay? So, given that the pair is now at 111, and given the ability of the Bank of Japan to waste their good chances to intervene in the market, there's a high probability that if the price remains in here, the bank won't act this June, and that would be catastrophic because if they don't act, the pair can plummet back again below those lows around 105.50 we have seen early May. Okay, that's the second thing I can make. And the third thing, of course, is the fact that we have broken above a major resistance, now support, right? The 110.60 region. We are quite close to it. But anyway, as long as we hold above it, the risk to downside is quite limited. But I am tracking also this 100 simple moving average in the daily chart, right? Because the pair seems unable to break above it. And I'm also watching this highs in 1190, 1112 region. So this is a critical level for me. I do believe that we need to regain this 1190, okay, to see the pair running up to 1480 or so. We have here multiple low highs in between 1460, 1480, right below the 15 figure, okay. So watch these highs to for breakout towards this ones, okay. But overall, I do believe that for now the pair is slightly bullish. Okay, not enough momentum. Needs a big catalyst to move, and it's not getting it. In the meantime, in the short term, 1145, which is the 100 simple moving average in the daily and this month high, and sorry, and this week high, the 100 simple moving average and the high of this week, it's a level to watch because if we break above it, we can go up to 1190, 112, and above that, I would expect the movement to extend towards 1240 the most, not much more, with the critical events we have later this week. And of course, the immediate support level to watch towards the downside is 110.60. As a break below it, could see the downward pressure increase first towards 110, then towards 109.50 here, right? This region, 109.40.50, which is the lowest I can see the pair this week. If I don't know, maybe the US payrolls are quite disappointing, right? And the Australian dollar, it's got a boost from Asian equities yesterday, sorry, this Tuesday is stocks in Asia skyrocketed, and the OC is enjoying some love. It has been consolidating as this lows after correcting the 61.8% retracement of the year rally, and seems that it's forming a bottom, right? It seems it's trying to bottom, an interim bottom. It seems that it's trying to correct higher, but still seems quite difficult, right? As I'm pretty sure I told you last week that after the Reserve Bank of Australia decided to cut rates, market run to price in a couple more rates this year. And well, with the latest Fed jumboning, the market has also priced in a rate hike in the coming months in the US. But I do believe that both situations, both central banks' decisions or future possible decisions, are already priced in, right? Um, and here we are trying to recover some ground. This is the current 70 to 60 region is quite a strong static resistance, and the pair has advanced at over 100 pips already today. So maybe we are not going to see too much further recoveries yet. I'm following this region 73, 73.30 because I do believe that up to that level it will be just a modest corrective move after the sharp decline of the past couple of months. Um, uh, we can see probably, maybe, not sure, not clear yet, selling interest resume, right? If that's the case, then I will be looking for fresh lows below the 71.30 region and closer probably to 0.60 figure, okay? And that's in the longer run. If somehow we manage to regain that 73.30 region, then there's a scope for the upward corrective movement to extend towards 75 during the upcoming weeks. Anyway, in the shorter term, we have a moderate bullish potential, right? 73, 73.60, 73.30, sorry, and 73.60 are the next resistance. And 72.10 is for me the immediate support. If we break below it, then the pair will probably go back to 71.70, right? And even towards those lows where we have bottomed twice this month around 71.40. But I'm not seeing much of a one potential in the OC this time, okay? The other one that seems to be having found some sort of bottom is gold, but in this particular one, I believe that the risk is still towards the downside. What I have noticed is that we have been plummeting for most almost 10 days in a row, right? And at some point, those extreme movements need a corrective move, and that's what we are seeing right now. But it's quite shallow, right? We are seeing quite a shallow recovery in here, and furthermore, in daily chart, we break below this trend line, below this 100 simple moving average. So overall, I believe that we can see an upward corrective movement, but most likely scenarios that the gold will remain under pressure, particularly because of high expectations of a Fed rate hike. Anyway, we flirted with 1200 yesterday, 1199.50 is for me the lowest for spot. So I would say that after some consolidation, some upward corrective movement, there's a good chance that it will resume its decline, and a break below this level would take us down to 1180. And furthermore, I do believe that this week can go down to 56.60, which is the next support of importance. And for oil, the commodity has reached 50 late last week, and here we are in consolidative mode ahead of the OPEC meeting. I really would expect it to remain consolidating, and I don't expect the OPEC to bring any light to the matcha. Remember, I told you I would say that bullish, but gains beyond 50 were not that much likely. Well, here we are. We reached that point, and now we need to let the pair consolidate and see what it can. The commodity consolidate and see what it can bring back next for us. Okay. Anyway, downside seems quite limited. There's little chances that we have a bearish shock at this point. So I'm really waiting for further gains. In the short term, 49.20 is the immediate support. But if we break below it, we can go as low as 47.30 without really affecting the bullish trend. It will be corrected, and we'll probably see some buyers surging around those lasts. Okay. Anyway, guys, my time is over. My call is worsening. But anyway, here we are. Here I am. Thank you for sharing this time with me. Okay, here we are. Thank you for sharing this time with me, and see you back soon. Okay, I believe that I will be covering live the ECB and payrolls this week, so see you back then. Okay, thank you and bye-bye.